And with that, Brian, why don't we get going? Thank you, everybody, for joining us today. I'm Erich Patten. I'm the Chief Investment Officer here at Cutler, and I'm joined by Bryan Knutson, a Senior Wealth Manager and a Certified Financial Planner here at Cutler. And today we're going to be discussing our second quarter review as well as our market outlook. So with that, why don't I jump into our presentation here. Here we go. All right, here on the cover page, come look, a Fed rate hike. In the second quarter, we, for the first time in what seems like, it seems like a year, we can see a Fed rate hike on the horizon. And that was probably the most impactful event of the second quarter when the Fed came out and said, maybe not 2023 for the first hike, but 2022 looks like their first rate hike, at least as they forecast it today. But before we get into that, let's jump into disclosures. You can see we have a lot of disclosures here. The summary of this is our views are subject to change. Obviously, new information comes available. Consult your investment advisor before making a decision about your investments upon any information you might hear in today's presentation. All right, so let's summarize. We're going to take 30 or 40 minutes to talk about these items in greater detail. But for those of you that like the quick elevator pitch, here's the summary of our outlook. Global growth continues to pick up after a US-led recovery. Consumer-driven inflation remains a primary concern. We're going to talk a lot about inflation, whether or not it's transitory, whether or not inflation sticks around. And then the third bullet point here, despite elevated valuations, equities remain attractive, especially versus bonds, due to the following: low historical rates and rapid earnings growth, as well as continued GDP expansion. So let's jump into this first point about global growth and the global reopening. Last quarter's market commentary, we called it the reopening conversation. There was quite a bit of focus on things opening up here at home, how fast we were returning to quote unquote normal. And the US led the way, and this chart really shows how the United States, along with the United Kingdom and Israel, was one of the first countries and really the first country of our scale to vaccinate a vast majority of its population. Well, you can see now the rest of the world is starting to catch up, especially Europe. Europe is, in some ways exceeding where the US is now. And we think that creates a conversation, or really an economic development for the rest of this year, for this recovery to not just be a US-led phenomenon, but to make it more of a global story, to have the rest of the world really opening the same way that we've seen the US, and perhaps economic growth following suit. So here at home, it's really been a consumer-led recovery. Brian, what are we looking at here? What's this chart telling us?
Okay, thanks, Eric. Hello, everybody. What we have here is a chart of some key consumer-led demographics, the first two of which could be done even during a lockdown. We start off, I'll look at the box here in the middle instead of the lines. The trend of the lines is they're mostly all getting better. The first one is mortgage applications. Last year, one thing we could do from home and to take advantage of low rates, lowering rates almost every day, literally for a while, was to either purchase a home or very often refinance a home. That got to the point where that was at about a +10 versus where we were 2 years ago. One thing to note on those minuses and pluses, on the current, that's not versus last year. Anybody could beat last year. We're looking at versus 2 years ago. Purchase mortgage applications, that number is starting to soften a bit. We'll talk a bit about why later on. The last four are the ones in particular. This shows the consumer is back. The numbers on here are as of 6:30. Even since then, they've started to get even better. Hotel occupancy is back to about neutral, and in some cases, specific locations, even getting better. US seated diners is back to about neutral. And the last one is going to be the most difficult one because of logistics involved, but TSA travelers. So who's on airplanes? We went from 4 out of every 100 people, the typical travelers being on an airplane, to 80. Now, the most recent data is it's about 85. That one could be the hardest to break through, but that is all trending in the right direction.
Yeah, I think the big challenge with TSA is business travel is not going to recover as quickly as leisure travel has. There's been a big shift in business of people doing webinars, such as we're doing today, or Zoom meetings, and it'll just take a while for TSA traffic from the business side to catch up. But looking at this is some of the hardest hit industries, that we're focusing on from the pandemic. Let's look at how they recovered, and especially as it pertains to wages. So on the left side of this chart, we have U.S. job openings, and something very interesting has happened in the current economic environment. We have a job opening for every unemployed American today. So we do not have a shortage of jobs. What we have is a mismatch of jobs. So people who lost their job during the pandemic, 30% of those say they don't want to go back to the same job that they had before. It would be convenient if everybody did, because then there would be a great matchup and people could just go back. The restaurant industry is really the one that's highlighted the most, and we see that on the right side. Bryan, can you walk us through that chart?
Sure. So what we're getting on the right-hand side here is monthly wage change. And what we see, the orange line is what's happening this year. The black line is what happened in 5 previous years. Again, we've excluded 2020 because that is such an outlier. What we see, not on this chart, but you might remember from last quarter, is that we've seen that the gap in jobs from what was to what is primarily in a few industries, a few very important industries as far as volume, especially since we are consumer driven. Like we saw from the previous slide, consumers are going to carry us. We're going to talk about that some more. But where do we see a need for jobs to be filled? Leisure and hospitality, retail, and transport. Those 3 areas are getting the most wage pressure, I should say. And if you took those numbers and annualized them, that's not scientific, but if you did, you would be looking at increases of 8 to 9%. What is that telling us? That, like Eric noted before, not only are people saying they don't want to go back to their jobs, people aren't. The number of people that have quit is at an all-time high. So there's a lot of mobility out there, somewhat because of the graph on the left, the chart on the left that shows that there's over 9 million jobs available. Of course, we're not going to get to 0% unemployment. That's just not feasible. But there are a lot of opportunities out there, so you have to be more competitive. What's interesting also, though, in aggregate, if you look at the bottom of this chart, the total is not seeing that much wage pressure. There's wage growth, sure, but that happens. You're not seeing it in aggregate because so many jobs did not have the exodus of people either by choice or because they had to. So you're not seeing it at a macro level, you're seeing it in pockets, but those pockets are very important to get our unemployment numbers down to where we're used to seeing them.
All right, let's talk a little bit about stimulus and government spending. And in past presentations, we've focused on this issue quite a bit. Today, we're going to back off talking about stimulus a little bit, but we do have a few slides to talk about spending, because we have seen pretty significant stimulus that did create this environment that, or at least had a role in impacting the environment that we find ourselves in. Bryan, there's a lot of data on this page. Why don't you focus us on 1 or 2 things that you think are really important to look at here?
Sure. So let's do this. Let's look at the top left and the bottom right. The bottom left is important, but we're going to look at some of those numbers individually. Let's look at the top left. This is like a balance sheet. It is the outflows and the inflows. The outflows are the total spending. If you look at the left-hand side, the one that is filled in completely, the total spending, the federal budget, is projected at $6.8 trillion. How does that compare to where we were at the end of first quarter 2020? It was $4.6 trillion. That difference is the amount of inflow so far in additional activity. Where is that coming from? It's coming from borrowing. It's coming from treasury issuance and things like that we're going to talk a bit about when we get to bonds later. The borrowing number, the one that's in the shaded area, was 1 trillion. Now it's 3 trillion. So essentially, spending went up by 2 trillion. Where did it come from? It came from borrowing. There we go. What is the impact of that? Let's look at the bottom right-hand corner. If you look, this is going all the way back to 1940. There was a time previous to this when debt levels relative to GDP got as high as they are now. That was World War II. Then since then, we've had some peaks. We've had some valleys. We've had some peaks. Now we're at where we are now. The 2021 assumption is that we're going to be at over 100% of debt to GDP. That is, there's concern about that. Let's just put it out there. Then what it looks at is a bit of a softening. You can see a bit of a trough there, and then an increase 10 years from now. That is a lot of projection for the CBO, the Congressional Budget Office, to make. That's a long forecast for them. They're usually looking at a 1 to 2 year rolling window. And what would that likely be from? The increased cost of debt maintenance. Where would that come from? Increased interest rates. Surely we're going to talk about that some more.
Yeah, we are in the bottom left there. It does show their assumptions for the 10-year Treasury, and you can see it climbing to 3.1% in the latter half of this decade. I think a lot of bond forecasters think we might get there sooner than that. But what I think jumps out to a lot of clients on this slide is when they see the chart on the bottom right with 102.7% of GDP in debt, a lot of people see higher tax rates. And that's definitely a conversation that the federal government is having right now. And when you look at this chart, it almost feels like an inevitability. So how those higher tax rates are manifested, we'll still see how everything shakes out in Washington. But a chart like this definitely makes you value a Roth versus a traditional IRA when you're looking at current tax rates and perhaps the value of 401k savers on whether they put money in a Roth versus an IRA. It's definitely something that you might plan for going down the road if you want to realize capital gains in today's environment. There's a current proposal out of the Biden administration to raise long-term capital gains rates as high as 39%. So there's a lot in this chart that investors can look at and begin to plan around. If you have questions about that, feel free to contact your advisor here at Cutler, and we can talk through how that might pertain to your specific situation. But let's talk about GDP. In this chart, it's a great summary. Again, it's a cake showing you all the different layers of what GDP is. But on the left side, you have the V-shaped recovery that we've all experienced. And while this has been a phenomenal recovery, a really exceptional event, you can see we're still well below trend line. No doubt the Federal Reserve is very aware of this fact. And this could be partly why the Federal Reserve is keeping rates low for quite a long time, and not only keeping rates low, but also continuing their bond purchases of $120 billion a month. So there's a lot that goes into this, but let's talk about the consumption-driven economy that Bryan alluded to earlier. And and Bryan, what is the prospects for GDP growth going forward when you look at the makeup of what constitutes GDP?
So again, if you look at the right-hand side, it looks a bit like it's a compilation. This isn't so much a balance sheet because we're not looking at any outflows. This is where does growth come from? It comes from us. The light blue shaded area, that's consumers, consumption. We are a consumer society. This has been the way it has been here in the U.S. for decades, for generations now. Other economies want to try to get to that level, and they're working on it. We're there. So what do we need? We need consumers to do what they're doing and keep doing it. So whether or not some aspects of pricing, we're going to get into some specifics, might go up, might go down, that's all fine. We can work out individual situations, but in the trend line, we need this to rise. What's interesting is that these demographics haven't changed very much, even with the lockdown last year and some of the other activity that's had to happen. Primarily, well, I'll put it this way, a large driver of that is that the money that came from that borrowing number that I showed on a previous slide has gone to consumers. All right, it's not government-led spending. Some other programs could be like infrastructure and such later, but right now it is money to households using that money. And what we're seeing is it's being used, absolutely. So if that trend line continues, that is an extension of what's already been the case for us and needs to be the case going forward. That number in the light blue has always been, for as long as I've been in this industry, has been 65 to 70% of GDP. It still is and still needs to be.
Yeah, and it really makes intuitive sense that consumers are in a very good position right now. A lot of people spent a lot less money in 2020. they received a lot of government support in 2021. And that combination really has created cash-rich consumers. What I see going forward, and what I think is really interesting from a policy standpoint, is we're currently debating a $1 trillion infrastructure bill. And that $1 trillion, you can see housing here at 4.8%. You know, just from the eye test, that looks like about $1 trillion. So add 5% to government spending in 2021 or 2022, it's really hard to see GDP contract in that environment when you have that much money flowing out into the economy. It bodes well for GDP growth from a top line standpoint. All right, so what has all of this cash done? And there's definitely been some distortions out there in terms of markets, in terms of prices. Part of this story is supply and demand imbalance. And you can see here on the left, lumber futures. Bryan, what caused this, and is it likely to sustain itself, or kind of what are you looking at when you see prices fluctuate like this?
So the one on the left is an example that has got a lot of attention for good reason. Lumber is something like, if you put a lie detector test on me 6 months ago and said, do you know the price of lumber? And I said, yes, it would have gone off the charts. I had no idea what the price of 1,000 square feet of lumber, or there's a calculation for this that I had no clue what it was. All we knew was it was starting to climb and climb and climb and climb, and it was getting massive amounts of notoriety. Because the lumber is used in so many different areas. There's home remodel, there's home construction, there's just other projects that would be going on, where this is a lumber futures price. This is similar to like saying for a barrel of oil. It doesn't mean I'm going to get a barrel of oil and put it into my garage, even though there was some joke about that when oil got to zero temporarily. This is saying, what is the projection of that area? And the projection was that it was going to massively rise and stay high. What did we do instead? It massively rose and came way down. It's somewhat like a meme stock almost, in that this projection was that there would be so many factors coming together to keep that price high that it was sustainable, and it's not. You know, so what do you do if you have, for example, millions of workers that are looking for a good job, and you have plants that are able to make treated wood? You go make more treated wood. Okay, that problem can solve itself. However, what is going on in some other areas? Look at the right-hand chart there. This is the price of used cars. This is another phenomenon, which is a big driver of recent rises in inflation that has been astronomical. This goes all the way back to 1995. From 1995 to 2020, it was on almost a non-existent climb, really. If you think about that on an annualized basis, it was about 1%. Woof, then a huge climb up. Why? Lack of microchips, since essentially cars these days are like a computer on wheels, more or less. So you had that situation where they weren't able to create supply. You have a lot of cash chasing a small amount of inventory. That leads to a price rise. This doesn't have the drop yet that the lumber price does, and this might take longer just because you can't go get some of those unemployed workers, put them in a factory, a mill, and make more cars. But this level of sustainability, this cannot be sustainable on an ongoing basis. It just doesn't make rational sense.
Yeah, and that's really the Fed's argument, is some of these price increases are not sustainable, and we'll see a reversion to the mean. The other side of that coin is that prices can be sticky, and they move up. If a restaurant raises their prices, I haven't seen many restaurants roll those prices right back. They try to keep those higher prices as long as possible. So we will see in terms of how much these changes translate into sustained inflation. But one place where we have seen inflation has been in housing. Here we go. On this chart, what I want to focus on, I know you can't read the fine print here, so just look at the colors of the lines. And the orange line is the price of houses. And you can see on the left side of the page here, we had the housing bubble up through 2006 into 2007. And on the right side, we have the current housing environment. And in many ways, the current environment has exceeded what we saw in 2000 or in the early 2000s. Prices are up 15% in the last 12 months. And unlike in 2000, when that was very much a coastal phenomenon where you saw housing prices going up in coastal areas. Today's price increases are really broad-based. It's on a national scale. Bryan, what's driving these prices? Is it fundamentals? Is it speculation? Is this the manifestation of stimulus and inflation, or what's going on here?
My first reaction to all of that would be yes. The interesting part here, if look again, just looking at the orange and the blue lines, in the 07-08 period, what we had there was a loosening, essentially a tear it up and throw it out of credit standards. It just said, yep, you want to get a house, you get a house, and you get a house. So you had prices rising with inventory rising. That doesn't make economic sense, right? If I have more supply, I should be able to be less demanding on price, and I should be able to get a better deal. It didn't turn out that way because you had a mass kind of run to the houses. That corrected itself in a very catastrophic way. For a while, we made it through that. Now, what are we seeing? If you look at those two on the right-hand side there, an increase in price with a decrease in inventory. Okay, now we're getting back to more of a classical example. On top of that, let's look at the right-hand side. This is a much longer chart, so don't think of these being the same time period. The one on the right goes back further, but those of us in the room, I wasn't one of them, but anyone who was buying a house in 1978, 79, 80 probably remembers getting an interest rate of 17, 18, 19%. Okay, that bubble burst, right? And then it started to come down. We have since then been on essentially a 40-year decline in real interest rates until we got to the point of now where we had rates go to zero, come back up a bit, go back down to zero, right? And then you build on top of that. So one reason why the price of houses can go up as much as they have is that the real cost to me has not changed very much. And I do this example a lot with clients, right? I could buy a $400,000 mortgage. I could have that mortgage with a 3.5% interest rate or a 375 at like a 3.75 interest rate, and the payment comes out to about the same. If you back into the amount you can afford, it gives you more rope to be able to go up higher in price. Okay, what we have seen most recently, if you look at the blue again on the left-hand side, it goes in jitterbugs, peaks and valleys, because builders buy or they build in kind of clumps at times. There has been a bit of a rise back up again. What is some of that going to be related to going forward? Let's go back to the previous slide with lumber prices. These all interrelate, and they're all going to be connected going forward, so that a combination of rates and lumber price and the willingness of builders to buy, combined with the willingness of people to buy the homes that they are building, that's all going to come together to decide whether or not this is sustainable.
Yeah, and I think it comes down to affordability. That was the point you brought up that I feel has most impacted these prices. If you look back to 2007 when we first had the housing bubble, and mortgages were well over 5%, and today a 30-year fixed rate mortgage is 2.5% or 3% right in there. The mortgage debt is the biggest debt that Americans own. And in the aggregate, Americans were using about 7% of their income to service mortgage debt during the housing bubble. Today, that's only about 3%. So even though we've seen this spike in housing prices, overall, Americans are using a much lower amount of their income towards servicing mortgage debt. All right, so let's continue talking about inflation, and really, the question is it transitory? And this chart shows CPI and core CPI, and let's talk a little bit about what those are, Bryan.
Okay, so if we look at the box on the top right-hand side, you're going to look at CPI, Consumer Price Index. That is the calculation of effective change in price for a wide basket of goods and things to me. Okay, the light blue line there is headline. That's the one that gets a lot of attention because it's usually a bigger number. The reason it's usually a bigger number is because it includes two things that are very important to know whether they are in your measure or not. That is food prices, that is energy prices. Over the last year in particular, and especially I know around Seattle, it's certainly true, the price of energy, and in this case, let's call it gasoline for cars, has had a huge spike up. I can see that if I drag down and look at energy CPI. Each one of these has its own calculation, then you batch them together. That number has shot way up. It's, of course, like anything, right? Like Mark Twain would say, lies and statistics and all that. It's coming off of a low number up to a high number. Sure, okay, we need to look at it in a bigger picture. But the big picture I'm looking at here is headline CPI. If I look at May of 2021 was 4.9. The most recent measure now is 5.4. Core CPI is 3.8 on this measure. Well, let's look at the 50-year average and let's look at today, or this last month, but still, let's say it's today. 3.8 to 3.8. What's the big deal? Okay, well, let's look at the number above it. 3.9 to what is now 5.4. Oh, okay. Is that going to be core, or is that going to be transitory, or is that going to be sticky? There's many reasons to say it could be transitory, the lumber prices, the car prices, the things like that. If you look at core CPI though, and you look at what are the components of that, when I remove food and when I remove energy, it still has to add up to 100% bubble, right? I mean, every pie has to add up to 100%. What is there? It's housing, and it's called owner equivalent rent. I always get that term a little mixed up, so I made sure I wrote it down. Owner equivalent rent is somebody calling me and saying, Bryan, you own a home, you don't rent it out, but what do you think you could rent it for? And I say, well, I don't know. That number is rife with errors because these are not renters. These are people that might be able to rent their house if they wanted to. That is something that, if I'm a little more in the inflation hawkish side right now, that concerns me, right? Because that is a number that we need to watch out for. It doesn't mean that it's going to be a sticky number forever. I'm not saying that we're going to ever get to the inflation numbers. If you look at that, the actual line graph, this is not a 77, 78, 80 situation. It's just something that is out there that could be the next thing. The other components are going to be medical costs, education, clothing, things like that. Medical costs last year actually went down because there was less sort of discretionary going to see the doctor. That number had not gone down since at least 1960. So some of these things are still in flux. Is it transitory? Nobody knows, either one way or the other, but lots of opinion, as there is in many things these days. But those are the key differences. One does include food and energy, one does not. Keep in mind, if you're looking at either way, housing is a big component, especially in the one that does not have food and energy.
Yeah, what jumps out to me on this chart is if you look at the blue line, there appears, at least to the eye, to be a correlation between recessions and spikes in the blue line. What may be different this time is how dovish the Federal Reserve is, because if you think what tipped us into recession in those previous inflationary episodes, it was rising rates. It was the Fed taking a position that they need to raise rates in order to slow down inflation. And today's Fed has stated on the record that they're willing to let inflation float a little bit and see what happens. So the risk of a recession is much lower in that environment. All right, so let's talk stocks a little bit in the S&P 500. And are we seeing inflation in the S&P 500? Our stock is the rise in stocks that we've seen this year, just because inflation is flowing through into the stock market as well. Bryan, what are your thoughts on that? And then I'll piggyback with some of my own.
Sure. So I'd say the biggest reason why I would say that stocks are not maybe overvalued more than they should be is the situation with bonds that we're going to talk about to conclude today. But stocks on their own, looking here, I would say for the period from last March 23rd being the low, hopefully the low for quite some time, and then where we are today, you can see that 92% rally in the big stock domestic index. Is that sustainable? The way that it can be is exactly the title of this slide. Can we grow into these valuations? So far, the trend line is yes. And how do I know that? I can look and see that in February of last year, we were at 19, I'll call it 19 dollars per the price per unit of earnings. The PE ratio was 19. That's a little high. 21.5 is where we are now. That's obviously a little bit higher than 19 even, but that is after a disruption, the likes of which I hope we never see again, and we certainly haven't seen. That's pretty good. One reason why, look at the dividend yield on that box in the middle there. Dividend yield last year, 1.9. This year, 1.4. Why has that gone down? Primarily because the price of stocks has gone up. I'm paying more per unit of yield there. Okay, but what's even more astounding to me is the 10-year Treasury it's a little bit lower than 1.5 right now, but for this discussion, let's say it's there still, 1.6 to 1.5. During all of the calamity of the last 16, 17 months, it has remained essentially unchanged. It has changed a lot during that time, but point to point, it's very similar. What have we seen to drive a lot of this phenomenon? A great stat I saw a couple of days ago, the amount of money, if Q3 and 4 of this year, this is a big if, but if Q3 and 4 have the same level of stock inflow, stocks and stock funds, as we got in Q1 and Q2 of this year, if this year stays on that trajectory, it will be more money this year into stocks than we saw the last 20 years combined. That's astounding. We already knew that many investors have sat out this enormous rally that we've had going back to, call it 2000, which is unfortunate. Oh well. But what we're seeing is participation in now, which can somewhat be a little bit of a warning sign. We need to watch out what those investors are buying, which leads to another point that's very important to know. Individual investors are a huge component of this now. There's so much cash, there's so much enthusiasm for markets. There's things like the meme stocks and all those things that we all know about that are driving up some very specific prices. If those people stay in stocks, maybe not in those stocks, but if they stay in stocks, that can help to maintain and sustain these levels of valuations.
Yeah, Brian, we got a question a few minutes ago when we were talking about consumers, and the question is, are future consumers going to be less copious in their consumption? What happens if future consumers consume less per capita given a change in personal values? And I read that question while we were talking about consumers thinking, where are we going to tie that in? And one thing that's been really interesting to see has been the boom in retail investing. And I would argue that that boom has largely been in that younger generation, that those Generation Z types of consumers who have stimulus checks, have discretionary money right now, and are looking for ways to spend it that are perhaps different than how their parents or their parents' parents might have spent their money. And I was going to wait until we got to our crypto slide to discuss that, but you kind of gave us an opening by talking about the money flows into the stock market this year. And you know, I don't mean to say crypto is where, you know, younger consumers are spending their discretionary money, but you have seen definitely a lot more adoption of crypto investing by that segment of the population. We got this, a question we had after our last webinar was, please address cryptocurrency. And at the time, Bitcoin was at $64,000. And magazines, Brian, you have a magazine around the corner from you on the desk that says, should Bitcoin be in your 401k? And at Cutler, we've always been a little wary of cryptocurrencies, largely because we don't know how to value them. You know, widespread adoption could increase demand, could create growth in cryptocurrencies. But as we've seen this last quarter, with that growth comes great risk. And this is perhaps the most volatile asset class that is being invested in by the general public right now. Brian, walk us through this chart that we're looking at.
Sure. So this is two of the major digital currencies. This is Bitcoin and this is Dogecoin. And you know, an advocate might say, well, Brian, you cherry picked the top. And I'd say, well, that's the point, right? So since May, what we have seen is these currencies have mostly moved together. Not all the currencies do. These have a history before this of not moving as closely together. But my primary concern is how quickly they've dropped, how uniformly they've dropped. And if you look down at the bottom, that's trading volume. Trading volume is a fraction of what it was several months ago. If I'm in a situation where I'm seeing a combination of drastically lower prices and drastically lower trading volume, that tells me that there's a very small number of holders pushing down this price on a very aggressive scale. And I'll tell you, that is what's happening, right? We have a very small concentration of owners of these positions. And that can happen in some other things, but they tend to be much more private style holdings. My concern here is that there's a tendency to get into a situation like this at a time when others are getting out of a situation like this. And maybe it's just because some of the the looky-loos, maybe some of the kick the tires folks have decided, nope, I'm not in this anymore, because that trading volume is almost nothing. And there are many articles out there about how it's a very small basket of holders, et cetera. It looks true. As far as retail buyers, there's difficulties sometimes of getting in, getting out. There are certain days, certain currencies are just not available. I mean, if you tell me that I'm going to buy into something that I try to sell it tomorrow, and they're like, yeah, sorry, whoa, that's a concern. So as far as the question that's on that magazine, Eric noted, does it belong in 401ks? I'm a heavy advocate for no.
Yeah,
no.
and I would say we're not trying to take a position on the direction of cryptocurrencies, more a position on the appropriateness of cryptocurrencies and where they would fit into an investor's portfolio. For speculative assets and investors that can afford to take on that speculation, have at it. For more retirement assets, investments that are part of a nest egg that's meant to sustain you in retirement, we don't think it's appropriate for that type of investment. So just be very careful about where you go about investing it in and with what money you do so. But let's move on to something our clients own, which is bonds. And, this last quarter, the bond market definitely voted on lower inflation. So we've spent a lot of time talking about higher inflation. And there's several reasons why bonds might have rallied. You can see this is in the purple line here, it's high yield bonds. In the blue line, it's the broad aggregate index. And after a big sell-off in the first quarter, it was nothing but up in terms of prices for bonds, with a little bit of sell-off. What happened in the middle of the quarter there, Brian?
So what we have here, this is the start of Q2 until the end. And what we saw was the first announcement of what was not that surprising to see, that inflation was higher than it was a year ago. Where it was going to be was still up in the air. That came in May. Had some selling off in bonds. If you sell bonds, the effective yield goes up, right? It's like a teeter-totter. So the effective yield on a 10-year went up to about 1.7 as the price went down. What do we see since then? Two more inflation readings coming out. They were even higher than they were before, but the expectation is that the bond market seems to be saying that this will be transitory. Time will tell. My opinion, no, but we'll see. It certainly doesn't mean I'm right. And the bond market in aggregate said no. And not only that, both traditional bonds, which is the blue line, and purple, which is high yield bonds, those don't always tend to move together. In this case, they did. Both of those marketplaces. So the kind of safe and sane bonds, the ones with full support and backing like treasuries, and high yield, really aggressive bonds, both of them said, nope, we're good, we're in. A 1.8 to 2% gain for a quarter. And again, this is not scientific, but if you magnify that over a year, and you're saying that if that came to be, and it was a 7 to an 8% return for bonds, wow, that of course after what happened in the first quarter, that's not realistic right now. But just saying, if that were to continue, this is not just saying we think this is the right way to go. This is a strong stand, and it sustained itself all the way through quarter end.
Yeah, there's two possible theories as to what's happening here. One is the bond market believes the Fed has the tools to make inflation transitory. The second is that the world is so awash with cash and starved for income that anything that has yield is being bid up. And which of those theories is the correct one, we don't know. But given the current dynamics of 5.4% inflation, 1.3 on the 10-year doesn't make a whole lot of sense. So that demand dynamic and money supply dynamic has to be at play at least a little bit in this chart. And in the next chart as well, where we talk about credit trends. And Brian, just summarize for us real quick. We don't need to spend too much time on this chart, but what is it? What are we looking at? Why is this important?
Okay, so I'm going to go to the bottom right corner. I tend to drift to the bottom right corner. That's where the meat of things are, I guess.
The important stuff's always there.
Always bottom right. Always look down bottom right. So what we're looking at here is high yield bonds, junk bonds, below investment grade bonds. I should get paid more to take the risk of being in those bonds. Historically speaking, That's what I'm looking for. Even today, that's what I'm looking for. What we know in general for bonds, and we're going to have a graphic on the next slide to really pinpoint it, but yield is hard to find. Yield is extremely hard to find. If I must be in bonds and I can't, like a pension fund or whatever the situation might be, and I have to have a bond position, I am looking at getting as much yield as I can relative to the amount of risk I'm willing to take to get there. I'm going to highlight one line. If you go to the bottom right section and you see broad high yield, the 20-year average on the credit spread, the amount of yield I should get for this relative to something that's like a treasury that's much more safe and sane, has been about 5.4%, 535 basis points, 5.4%. Today, it is literally half of that. It is 2.7. Why? Because I am willing to bid up to get that additional yield I'm not getting anywhere else. There's the two things here. There's two very important factors about this. One of them is this is the way to get yield. If I need current effective real yield, this is one of the best ways to do it. The second one is these issuers are very low rated companies, right? I'm not going to issue these kind of bonds if I don't have to keep my venture moving forward. They're very often energy related, pipelines and whatever else it might be. This is a sign of confidence that those will pay, right? I'm not going to buy one of these bonds intentionally saying, oh, this is going to default tomorrow, but whatever, I'll see if it works out. I have to be willing and able to say, yes, this will pay out to make this buy worthwhile. This is a sign of confidence in the sustainability of lower quality companies from a credit standpoint to be able to maintain their payments. That's a good sign from that regard.
Yeah, it's a good economic sign that credit spreads are so tight. It's definitely a risk for investors, especially investors who have exposure to junk bonds. But when you're looking for an endorsement on the health of the economy, high yield spreads are definitely something to look for. So with yields now back to their lows, not their all-time lows that we saw last March, the question for income-looking investors are there reasonable valuations out there of income-producing assets where you can get some income in your portfolio. And this chart shows the current yield for a variety of different asset classes, with emerging market debts on the far left all the way to U.S. growth stocks, not surprisingly, the lowest on the spectrum, and they have been for quite some time. So that's not a new development. But Bryan, does anything on this page jump out as a current value, given the multiples of the U.S. markets and the risks that are out there currently?
So I won't go to every single one of these, won't bog us down with that, but essentially to get yield, I have to be willing to take risk. We saw that on the previous page. This plays it out again. What's really interesting to me here is several things. There's a lot of concentration of yield in that high ones to low twos area. Developed markets, international markets are paying more than we are. That's one of the big reasons we like them, plus valuations. U.S. value stocks are paying more than a 10-year treasury. There we go, right there, right? I mean, stocks have their own, they have much more volatility than bonds. I wouldn't want to downplay that. But when I have bonds stretched for valuations beyond any measure that I've ever seen, and I have value stocks that are actually not that expensive, there we go, right? That's a nice combination there. But essentially, there's a whole lot of pieces that are right about the same for yield. I would look for a combination there of upside plus recurring yield. That's always what we look for. And real yield is hard to find, so we just have to look for it in in unique ways.
All right, and our last slide of the presentation. Thank you all for bearing with us here and marching through the current economic conditions with us. But this is what we call our quilt chart because it looks like a quilt. And what jumps out to me on this slide is the negative return for bonds. And we did talk about the rally in the second quarter for bonds, but given where bonds have rallied back down to, it's not surprising that they have risk here. A small sell-off in the bond market can translate into negative returns, and you can see over the last 15 years that hasn't happened really in any other bond market other than 2013. You had a negative year, but it's really rare to have bonds with negative returns because they have those consistent cash flows that offset price drops. but the risk is still there, and we would still advocate investors don't push out the maturity of their bonds, but keep that maturity short to medium term, intermediate, and really push down credit as opposed to pushing out the duration of your bonds. And then the other thing that I think is really interesting to look at here on this slide is the outperformance of value versus growth stocks. And on the last slide, Bryan highlighted value stocks. We still think value has room to run here. And the reason for it is we've seen interest rates drop during the quarter. And as that happened, the gap between value and growth shrunk. So growth really favors this low environment or low interest rate, risk-seeking type of environment. Well, what happens if rates were to rise? Value stocks, and you think of a big value sector like financials. Financials could benefit a lot from that interest rate rise, from a rising rate environment. So we think value stocks are really well positioned as an offset against the possibility of rising rates. And if rates stay where they are, we still think they have good value just based on that sustained GDP growth that we talked about earlier. So those are two asset classes that I'd highlight on this page that I think are particularly interesting to look at as we head into the second half of the year. So with that, I just want to thank everybody for joining us today. And should you have any questions about anything we've discussed, please feel free to reach out to your advisor. Bryan and I are also available at any time to answer your questions and discuss in greater detail something that we mentioned here today, maybe something you disagree with or something you do agree with, and see how it might impact your portfolio. So with that, thank you very much and have a wonderful day.
Thank you, everybody.